Are you positioning for a recession?
Good morning, Alex. Thank you for having me. To answer your question, are we positioning for a recession? I think our base case, as your prior guest mentioned, there is a lot of recession already priced into the market. Gosh, it's hard to believe that we're in near bear market territory with the S&P down almost 20% year to date. NASDAQ down 25%. So, I think from a portfolio management standpoint, take advantage of the volatility. Now's the time to rebalance out of growth, overweight, value, dividend-paying stocks. And, for long-term investors, I think that there's opportunities if you have cash to get into names that you haven't seen valuations here like you are today since 2020.
So wait a second, let's just break that down a little bit. So if you've got cash, does that mean you want to be buying growth? But if you've got growth, do you want to be selling the growth and buying value?
Good question. So if you have cash, from a portfolio standpoint, we're overweight dividend paying stocks. There is a lot of uncertainty right now in the market. We don't know what the Fed's going to do. There's a lot of reports coming out with slowing GDP growth. So I think you want to be in safe companies that have strong balance sheets, defensible business models, strong free cash flow yield. If you're a young investor that has a 10+ year time horizon and is looking for to buy companies, sometimes we'll say to bottom fish, to buy companies at a low price. I think I was looking over the weekend. You look at NVIDIA. NVIDIA is trading at a cheaper multiple than Clorox. NVIDIA, arguably the largest chip maker in the world, at a cheaper forward PE than Clorox. So I think there's not all tech is the same, and I'm certainly not suggesting just go into tech, but you have to be selective.
So talk a little bit more about that, because currently the market, like the top performing stocks right now, CF Industries, Occidental, Apache, Mosaic, so the commodity levered names, that's obviously how you're going to position in somewhat in terms of inflation. Do you want to be investing in those right now, or do you need to be buying the beaten up like Apples and Googles? Like, they're not going to lose all their revenue or have that kind of risk like Carvana, but they've been beaten up quite a bit.
Yeah, it's a great question. I think in the short and medium term, I think the leaders that you mentioned, the safer companies will continue to outperform. I think if you have a long-term time horizon, companies like NVIDIA, companies like Facebook parent Meta is trading at 14 times earnings, Google's Alphabet trading at 18 times earnings. So there's certainly value to be had as a call across a style of investment. Overall, I continue to think large cap value will outperform.
Okay, in terms of some of those multiples that you've just been naming, clearly not all tech is the same, but ultimately tech has benefited from higher multiples because rates have been super low and have been there for a long time. We were talking to a guest Friday who was talking about this idea that maybe actually if rates stay at a more elevated level going forward from here, what you're going to see is a more permanent shift lower in the valuations that you can ascribe to some of these names. Do you think that's going to be the case? Yes, they're trading cheaper than they were, but are they going to, even if they bounce from here, are they going to bounce that much?
Yeah, I think that you look at what was considered big blue chip. You look at the utilities, AT&T, Verizon for years, those were the safe companies. I think that some of these, as you mentioned, Guy, not all tech is equal, but some of these big companies, Microsoft, Visa, Apple, they're not going away. I think that is those are so entwined in our daily life that those companies are still going to be here. But I think, again, you have to be really selective. There's a lot of risk still in the market. So I think it's a stock picker's market, and you want to be selective about the companies you're in.
We were also talking earlier about inflation and then what that means for the consumer. How do you play a consumer where savings rate is decreasing, but typically the consumer tends to hold up well? What do you do with one that may be deteriorating?
Yeah, so we talked a little bit about being in safer companies, dividend-paying stocks. If you think that inflation is going to continue to persist at least over the medium term, which we do, real assets should continue to perform well. And then, I think we've been incorporating structured or market-linked investments that use options to provide some downside protection, but also upside participation. So we're getting a little bit more defensive. I think there's a lot of weakness already priced into the market, but we're not out of the woods yet.
Final quick question, Elizabeth. How long do you think we're going to be in this period of volatility? How long do you think investors are going to have to be whipsawed on a day-by-day basis, week-by-week basis?
I think volatility is here to stay. I think that you need to take a long-term time horizon. You need to have an asset allocation you're comfortable with, know the companies you're in. If you understand the financials of the companies you're invested in, it's a lot easier to hang in there with the market volatility. But I think that's here to stay.